Okay, so welcome to this first part of this series where we're going to be looking at building profitable trading systems, right? So we're going to be exploring the dynamics that goes around building profitable trading system. Now, in today's lesson, we're going to be looking at identifying what I call your bias or your trade direction. All right. So the first question you need to answer, or any system needs to answer for you, is whether you're going to be buying or whether you're going to be selling. All right. So are you going to be a buyer or are you going to be a seller? That is the very first question that you need to answer whenever you open or you seek to do anything around trading, right? So you need to know, should I be going up? Should price be going up? Or should price be coming down? Now, one of the things that I discovered that many newbies make is that they don't really have a plan around deciding whether they should be buying or selling. So they do a whole lot of random things, and of course, they get very random results, which is not what you want. So you need to be able to assess. You need to have a definite approach towards assessing whether you should be buying or selling. So in today's lesson, I'm going to explore the three ways that you could do this. Every system that you can think about basically falls into these three ways. Some might be a kind of an intersect between two of the things I'm going to be sharing today, but every way of obtaining your buyers falls under these three. So you need to understand it. Then I'll also discuss some of the pros and cons of each of these styles. So let's get into it. As always, if you are yet to subscribe to the channel, please do so at the moment. Like the video if you like the content that is going out, and you can also share it with your friends or other traders who you know might be interested. All right, so let's get into it. The first one is fundamentals. Fundamentals. So everything I'm talking about could also add analysis at the back. So fundamental analysis, then we look at technical analysis. We also look at sentiment analysis. So you could just call fundamentals, or you could say fundamental analysis. Now, when it comes to fundamentals, we are basically looking at the economy. We are basically looking at the strength of the respective economy. So let's say we are trading Euro USD, right? So there are two countries that are involved. So whenever you're looking at your currency pairs, you always have two countries involved. Now, if you're trading things like indices, right, you have one country involved, right? So you always need to understand the dynamics around this if you're looking at fundamentals. So but for the purpose of this discussion, I'm going to be restricting myself to FX, right? I'm going to be restricting myself to FX. Now you can use it to even push beyond that, right? But to make this discussion a bit targeted, make it a bit narrow, all right, we're going to be looking at FX. Now, whenever you pick up an FX chart, there are two countries that are involved. All right, so you have what we call the base currency and you have the host currency. So, and that is coming from two different countries. So Euro USD, for instance, your base currency is the euro and your host currency is the USD. So it means that one way or the other, whatsoever thing is happening with the economies of those two countries is basically going to be playing out to some extent on your price chart. Now, the most important of the things you should be looking out for when you doing your fundamental analysis is the interest rate. Is the interest rate because at the end of the day, when we come to the broader market, I don't mean just from an intraday perspective. Intraday perspective, usually it's liquidity that usually drives a whole lot of things. But from a longer term perspective, when you're looking at what will happen over a week, over a couple of weeks, and all that, it's always driven by um, fundamentals, really, right? So that is already one of the pros, is basically what drives price charts in the long run. So in the long run, price charts are being driven by these fundamental factors. They're not just being driven by, oh, there is an order block somewhere, or there is a trend line somewhere, or there is support. Certain things are causing those things to happen. The reason why there is a ton of buying, if you're using something like demand and supply, the reason why there's a ton of buy orders somewhere is because some of the big players, we retail guys, we don't do anything to the market, right? So it's because certain big players see a reason to go in that direction, right? They see a reason to go in that direction. Now I don't have time to, or maybe when we get to sentiment, I'll touch on it a little bit of the various players that we have in the market and why they are in the market, and how their orders tend to interact with other players in the market. So the main thing is that um, liquidity always tries to follow yields, right? So, and yields are largely determined by interest rates. So let's assume that you are a business, right? And you are looking for the best value that your money can give you. Now, a particular country interest rate is at 5%, right? And so if you basically keep your money in a place, right, you'll be getting around 5% interest rate, right? So let's just use that as a broad, that doesn't necessarily mean that it's the case, but let's just use it as a broad stroke to make this analogy easy. Now you're getting 5% in country A, and then country B is giving you about 3%, right? So where will you likely move your money to? Of course, you're going to move your money to country A, right? Because you're going to be getting 5% as against 3%. Now, what if, let's shift the dynamic a little bit again. Now, what if you had two countries? Now, country A was giving you 4%, right? Country, so country A is giving you 4%, and then country B as well is also giving you 4%. All right, now two of them are giving you 4%, but a particular central bank then comes on board and says, "Oh, I think it's time for us to begin cutting rates, right? So to begin to reduce rates." And then the other country is saying, "Oh, we need to keep rates higher for longer." All right, now they have not done anything to the interest rate, but what has happened? They have changed the expectation. They have changed the expectation of what the future rate decision will be, or what the future rates will be. So price doesn't just react to the current interest rate alone, it's also reacting to the perceived future rate or future part of interest rates, right? It's reacting to the perceived future parts of interest rates. So if you feel, okay, at the moment, we have already seen, it could even be that country B is lower than country A, but you are feeling that country B is going to start raising while country A might start reducing or stay stagnant. What will happen? They'll move your money to country B. All right. They are looking at the future parts. They're also anticipating what will happen in future. Now, the next one I need to talk about is bond yields. Now, bond yields are a very, very crucial way of knowing what is going on with a country. Now, most of that interest rates, I talked about interest rate initially. Now, most of that interest rate is factored into the bonds. So when a country wants to raise money, right, it doesn't go to the stock market the way companies do. So it instead issues what we call bonds, or issues what we call treasury notes, right? So now when it issues these things, these bonds have something we call a yield. That is the amount that you are supposed to get as interest on that bond. Now, the more people are buying, what's it called? The more people are getting involved um with the bond, what usually happens, right? So demand and supply, right? More people want to buy a particular bond. What happens? The bond price goes up and the yields basically drop, right? So, but let's not go into that. So, what I want you to understand is that when the yields are going up, right? When your yields are going up, What it basically means is that it is very likely that the currency is also going to go up alongside it. It means uh, the interest they can get, just look at it that way, the interest they can get from from lending their money to the government has increased. So bond yields are basically the interest or the profit that someone gets from giving his money to a government, all right, from lending to the government. So one of the ways we look at this, we're going to go into the charts now. All right, so we're going to go to TradingView and then I'm going to show you something. So I'm going to put in here the US 10-year. So you see this United States 10-year government bond yield. All right, so if we introduce it to this chart, so you can see how this has been on the increase. Now I'm going to overlay it. So we are going to use this compare symbol and we are going to compare it with the dollar futures, US dollar index futures. So what we need to do is to come here and we are going to move this to a new pane below. All right. So to make this for ease of comparison, I'm going to change this to, just do this. I'm going to change this to a line chart as well. Now, what do you realize? You will see that price, this first started pushing up. This was the first one to break through this level, right? And then begin to push up and push up and push up and push up. What do you realize? As this one begins to come down as well, what is happening to your dollar futures is also coming down. It's also coming down. So that is the correlation. There is a correlation between what is going on with your, this creates a bottom here, your futures creates a bottom as well. Creates a bit of an intermediate high somewhere around here. You see a correction, create another bottom here, begins to push all the way up. All right, and then begins to drop. Now, if you're just using this like this alone, it doesn't paint the whole picture. So I'm going to do something else again. Now I'm going to change this from just a 10-year treasury bill, and I'm going to compare it to, so we're going to use equal to, and we're going to compare this to the German 10-year treasury yield, because that is what we have for the euro area. Uh-oh. What happened? What is it saying? Invalid symbol. All right. So, okay, so since we're adding to the watch list that you're supposed to use that equal to sign, usually forget that. And then for this, I'm going to come and change this to Euro USD. I'm going to change this to Euro USD. So let's use Honda. Oh, should have done this. Is Euro USD, not USD Euro. So this should be the other way around. All right, so DE 10-year minus US 10-year yield. All right, so let's do a walkthrough. All right, so what do you notice? See how correlated the charts are. This is pushing up, pushing down, right? You can see how correlated this is. It's pushing up. This is pushing up. It starts to correct. This also starts to correct. Highly correlated. Highly correlated. All right. So majority of the time, this is what you are going to see. Right. So this, you can see this is still in a downtrend. Now this one looks, if you are just watching Euro USD, it will look to you that we are going into an uptrend. But what happens? Your yield is still showing you this is still basically a long-term downtrend. We haven't broken above this primary point, right? And as long as we haven't broken above that point, we are still largely in a downtrend. And of course, Euro USD eventually aligns and rolls over. Now, that is one of the cons that I need to mention whenever you are looking at fundamentals. Sometimes it can take a while for it to play out. Price might still be doing something contrary to what the yields are doing before it then eventually aligns and begins to play out, right? But you can see how correlated these things are. All right. So one of the statements that when I was getting into the market, I heard a lot is that price, liquidity, or money follows yield. So money follows yield. So people, the big players uh, are not just interested in just anything. They're interested in getting the biggest returns they can for their money. And one of the ways they do this is by buying assets such as bonds. The bond market is one of the biggest markets in the world, right? So this is what usually drives them to push their money into somewhere. So let's imagine you want to buy the US Treasury bond, for instance, the US 10-year bond. What are you going to have to do? If you're in the Eurozone, you have to convert your money to the US, to USD, and then buy the bond, right? So in converting your money from Euro to the USD, what has happened? You have joined the group of people who are buying the USD against the Euro, or in other words, who are selling Euro USD, right? So I want to buy the US bond because it's going to give me greater yield than the German bond or the Euro bond, right? So what has that led to? It has led me to sell my Euro and buy the USD. So I have sold Euro USD. So those are the things that result in having those massive moves in the market when they begin to realign or they begin to cut their positions down in certain bonds and all that. So that we don't make this video too long, let's jump it to economic data. So when we talk about economic data, we're talking about things like inflation, we're talking about things like employment, we're talking about things like the PMIs, the Purchasing Managers Index, and all that. Now, the reason why all these things are important at the end of the day is depending on how it's going to affect interest rates. So the only reason why this data is important is that it's showing us, one, it's showing us the health of the economy, yes, but most importantly, because it's going to give us an idea of what will happen to interest rates, right? If any economic data is not going to have much of a bearing on interest rates, it's not going to be much to be watched out for. That is why when you come to the US, for instance, where the central bank has two dual mandates, which is maximum employment and to keep unstable prices, right? So that is why you see that the two biggest market movers outside interest rate decisions are the CPI, which monitors inflation because of stable prices, remember, and NFP, which monitors employment, right? So you see how these things feed into each other. So it's because of what the central bank is going to be looking at to determine interest rates policy decisions that makes certain data a red folder or not red folder. So the more weight the central bank is going to attribute to that particular data in making interest rate decision, the more crucial that data becomes. Right. So it is not just one thing. So there will be a time, for instance, early late 2023, 2023, and 2024, the US had been fighting this fight of um, I've been looking at interest rates from an inflation perspective. So people have been expecting them to start cutting, and they have been looking at inflation data. So at that time, the crucial thing was inflation. So every single CPI report was key, was very important. Now, as inflation is gradually coming under control, this is November 2024, you are seeing they are beginning to place greater emphasis on the employment component of their mandate. So the employment data has now started becoming even more important than just the CPI. So if you look at the recent CPI reports, good, they have largely been in line with forecasts and all that, but also it's because the weight that is being placed on inflation is reducing compared to unemployment or employment data. All right, so let's move along. So what are the pros and the cons? I've mentioned one already. Pros is that this is basically how the big institutions trade. The big institutions are not really after the moves that happen in the day, except to provide market making functions. I will talk about that when we get to sentiment, except they are providing market maker functions to other players in the market. Now, their main goal is to follow yields. They are looking for the best value for their money. So this gives you an idea of what they are likely going to be doing. Now, the cons, it might take a very long time for it to play out, right? So the banks, the big banks, they don't have a short-term horizon. They are not looking at just today, tomorrow. They are looking at weeks. They are looking at months, right? Those very big players, they're looking at weeks. They are looking at months for their decisions, right? So you might need to have a deep pocket in order to weather the temporary drawdown that you might have while price continues to move against you before it aligns with um, the broader fundamentals in the marketplace. So let's jump right into technicals. Now, when we are talking about technicals, there are two things that we primarily are looking out for, and that is indicators, and then we have market structure, or what some other people also refer to as price action. All right. Now, the key things about indicators. Now, whenever we are looking at indicators, it could be anything. I remember all the indicators we used when we are starting out. Your moving averages, of course, you are told if price is above a particular moving average, it's bullish. If it's below the moving average, then it is bearish. We're just looking at what can tell us whether to buy or to sell. Right, that is all we are looking out for. Now, you could also have things like your MACD. All right, when your MACD crosses above zero, then you buy. Or it crosses below zero, then you sell. Things like that. You could have your something like your stochastics, which tells you, okay, we are in an overbought um, scenario, then we should be looking for a reversal. So we should be looking to sell, or we are oversold, you should be looking to buy. So that is basically what your indicators are all about. Occasionally, some other people will tell you, when you have your moving averages stacked together. In fact, let's look at some examples. So it's not like I'm just rambling and rambling and rambling on. All right, so let's reset our charts. All right, so let's take all this out, take it back to our normal futures. And I'm going to take this out of the way. Or I think I'll be better served doing this on my MT4. All right, so we could see something like this. This is called an envelope, right? And we could simply say, as long as price is above this lower boundary, then we are looking to buy. As long as price is below this lower boundary, we are looking to buy. And as long as price is below this upper boundary, as long as price is below this upper boundary, we are looking to sell, right? All right, below the upper boundary will sell. So during this place, you could have been having opportunities to buy, sell, buy, sell, buy, sell, buy, sell, and we are moving on. So if you play around with it, you could see how that would have worked. And of course, your envelopes is largely based on a moving average with some deviations. So something like that could actually work, right? If you look at this, you would have seen how that could have been solid, especially if you are looking to sell or maybe add some other confluences to it. So do indicators work? Yes, they do work. If you know what to do with them, they do work, right? So I'm not going to be one of those people who tell you indicators don't work, you are trading indicator, you are this, you are that. It's a lie. People do use indicators and do use indicators to make money. So don't let anyone deceive you. You just need to be aware. You need to understand the indicator you are using, understand what it is showing you, understand its limitations, because like every other thing, it has limitations. Everything in this market that we use have their own limitations. Some limitations are more pronounced than others, but everything has their own limitations. So you need to understand what exactly it is showing you. You need to do what we call a back test. So many people, they just accept hook, line, and sinker, whatsoever thing is said to them. You need to do your own back test, understand it, and then be able to come up with a system for doing things. So, for instance, you could use, I remember when I was at one point, one of the things that I was using was three moving averages, right? Having three moving averages. So, a situation where you have something like your 200 EMA, your 100 EMA, and your 50 EMA. So, if the 50 EMA is below the 100 EMA and the 100 EMA is below the 200 EMA, then we say we have a what? Have a downtrend. Now, if they are in between each other, like the 50 is in between the 200 and the 100, then we have what we call a ranging market, and that is not where we want to play. We don't want to trade during those kind of situations. And then if it's the other way around, the 50 is above the 100, the 100 is above the 200, then we say we have a what? An uptrend. So these are various things you can play around with. Personally, I'm not a big fan of the whole overbought, oversold thing, but it does work. But you need to understand where it works. Now, it's going to work on pairs that are correlated. It's going to work on pairs that are correlated. So pairs that tend to move together. So things like your euro and your GBP, all right, they tend to move together. Things like your AUD and your NZD, they tend to move together. So when uh, it has stretched in one direction, it's more likely that it is going to snap back so that the two of them can begin to align again. So in such situations, your overbought and oversold will work. However, if you try to go and use your overbought and oversold things in pairs that are uncorrelated, like your AUD JPY, that are on opposite ends of the risk spectrum, you might see a trend continue for months and months on end, right? So you need to understand the where everything, how everything works, right? Before choosing to use another one. Now, because of our time, I'm going to have to make a part two of this. So in the next lesson, we are going to be talking about market structure, price action, the hierarchy of time frames, and then we'll also be discussing sentiment. Which for me, I believe is really one of the best ways to trade sentiment. Yeah. So we'll look at market structure, price action, and I'm going to be sharing with you how I came up with both the swing shots, the fractal OF. Going to be talking about this issue of hierarchy of time frames, and then of course we'll look into sentiments, and of course I'm going to be sharing with. I'm going to also be mentioning how you could intersect two or more to give you a higher probability of being right in the chart. So if you've enjoyed this video again, please do subscribe to the channel, share the video, give it a like. I want to hear your opinions. I want to hear your comments. Just drop your comments below and we'll see in the part 2 of this video.